welcome to Griffonomics.
Yeah, thanks for having me. We have a really fascinating stack of intelligence to get through today.
We really do. I mean, right now, there are private AI startups generating over $6 million in revenue for, every single employee on their payroll.
Right.
Meanwhile, legacy tech giants, the companies whose software you probably logged into this morning to do your job, they're suffering a massive 35% market collapse.
It's wild to see the data actually backing this up. We're unpacking Redpoint's 2026 market update today, alongside a series of highly detailed strategic analyses.
Exactly. And our mission for you on this deep dive is to basically cut through the noise.
Yeah.
We want to generate a really granular strategic analysis and, more importantly, an actionable investment roadmap.
Yeah, based purely on the data.
Right. Based on the data, we're zeroing in on this fundamental collapse of legacy horizontal SaaS, the structural dominance of vertical SaaS and AI-native startups, and, what this massive tectonic shift means for the future of your portfolio and the broader economy.
Because the ground beneath us has just fundamentally shifted.
Yeah.
I mean, if we look at how we used to think about technology, software was just a tool. Right?
Right. You bought a tool.
Exactly. A company bought software out of their IT budget to help their human employees do their jobs better or faster. But today, we're facing an inflection point. This transition isn't just a technological upgrade. The sources define this as the labor TAM inflection.
The labor TAM inflection. Let's unpack that term for a second, because TAM is total addressable market.
Right.
So when we talk about a labor TAM inflection, we're talking about a fundamental shift from companies buying software to buying the actual work.
Precisely. And the Redpoint analysis visualizes this through what they call the agent maturity curve. Right. So for the last 2 decades, software companies were fighting over a traditional U.S. software budget of roughly $500 billion.
Okay.
Yeah, $0.5 trillion.
Yeah.
And they built what we now categorize as copilots. These are basically assistive tools. They run for seconds. They auto-complete a sentence or summarize a document.
But the human still does the actual work.
Right. The human is at the wheel. So they're just fighting for that $500 billion IT budget. But as AI capabilities advance, they stop just helping and they start doing, which unlocks entirely new, much deeper pools of corporate spending.
Right, because you move past the copilot, what's the next step?
The next step up the curve is task agents. These actually execute discrete tasks end-to-end with just some human oversight, running independently for minutes at a time.
So give me an example of that.
Think about an AI that doesn't just draft an email, but pulls a client's billing history, drafts the invoice, and queues it up for approval.
Oh, wow.
Yeah. Suddenly, AI isn't just tapping the $500 billion software budget, it's eating into services automation. And that expands the addressable market to $1.2 trillion.
$1.2 trillion, okay. And then we hit workflow agents, which the data says run for hours, right?
Exactly. They run for hours, and they orchestrate multi-step processes across entirely different systems. So a workflow agent might monitor incoming support tickets, query a back-end database to diagnose the issue a refund, and update the CRM.
And all of that without a human ever touching a keyboard.
Right. And now you're eating into operational payroll, which pushes the addressable market up to $2.8 trillion.
That is a massive jump. And then there's the final stage, right? Autonomous agents.
Yeah, autonomous agents.
Mm-hmm.
These perform complex knowledge work over periods of days with minimal oversight. And when you cross that threshold, you are targeting the entire knowledge worker payroll.
Which is?
That is a $6.1 trillion total addressable market.
Wow. It's like the evolution of the automobile. We've gone from power steering, which is the co-pilot, making the driver's job slightly easier, to fully autonomous driving. You aren't just selling a fancy dashboard feature anymore. You're replacing the need for the Uber driver entirely.
That's a great analogy. You're buying the completed journey, not the steering wheel.
Mm-hmm.
And that shift in value capture is completely unprecedented.
So I have to ask the question that is inevitably on everyone's mind right now. We're throwing around numbers like $6.1 trillion, right? We're talking about paradigm shifts. Is this just the dot-com bubble 2.0?
It's the natural fear.
Yeah. Are we looking at a speculative frenzy where the hype has completely outpaced the physical reality of the technology?
Well, the data firmly debunks that narrative, actually, by looking at the underlying mechanics of the infrastructure build-out.
Okay.
If you look at the year 2000, during the telecom and internet boom, the infrastructure was built purely on speculation. Telecoms were laying fiber optic cables because capital was cheap, just hoping consumer demand would eventually materialize.
Right, they were just digging trenches.
Exactly. It was largely funded by debt. And at the peak of the bubble, actual fiber utilization was sitting at under 3%. Revenue significantly lagged behind the capex.
So in 2000, we built bridges, hoping cars would eventually be invented to drive on them.
Right. But today's AI build-out is entirely different. Hyperscalers, companies like Microsoft, Google, Meta, Amazon, they're deploying over $700 billion in capital expenditure. But that spend is driven by immense real-world demand.
How do we know the demand is real, though?
Because over 90% of new data center capacity is pre-committed by customers before the ground is even broken.
Wait, really? 90% is already sold?
Yes. The hyperscalers are frantically paving roads because there's already a massive traffic jam of AI demand. And critically, this is largely funded by existing cash flow, not debt.
Okay, that's a huge distinction.
And furthermore, the foundation model labs themselves, like OpenAI and Anthropic, each of them are already generating over $20 billion in annual recurring revenue. The infrastructure is actually desperately trying to catch up to real-world usage.
Okay, so if $700 billion is being spent on compute power to run these agents, those agents have to be pointed at something.
Right.
And right now, they're being pointed directly at the core products of the legacy software giants. If AI is now autonomously driving these workflows, what happens to the legacy software companies that were, just building the digital dashboards?
Well, this is what initiates the great bifurcation in the software market.
The great bifurcation.
Yeah, the market is violently separating the winners from the losers based entirely on structural defensibility. So legacy horizontal SaaS companies like Salesforce, ServiceNow, Atlassian, they're suffering a massive 35% market sell-off over the last 12 months.
35% is a bloodbath for entrenched tech monopolies.
It really is.
But think about the software stack you log into every morning for work. Many of us use tools like Salesforce or Jira constantly. Why are they specifically being targeted for collapse?
Because horizontal platforms were built to serve every industry equally. By design, they do not integrate deeply into the highly specific regulated workflows of any single sector. Historically, they were built to solve what economists call coordination problems. They track who's doing what and when. Who called this client? When is this ticket due? Has the marketing team approved this copy?
But modern AI natively solves coordination problems.
Exactly.
If an autonomous agent makes the sales call, logs the transcript, analyzes the client's sentiment, and then automatically schedules the follow-up meeting, you don't need a human logging into a dashboard to check a status box.
You really don't. And if the core value proposition of your product is something AI does by default, that's not a new feature you can just add. It is a fundamental threat that replaces your entire product. And because these horizontal platforms lack deep industry-specific data, their switching costs are actually quite low, so they're highly vulnerable.
So then who is surviving this bifurcation? What does the safe harbor actually look like for an investor or a founder?
Vertical SaaS. These are highly specialized companies like Viva in life sciences, Procore in construction, or Toast in restaurant management.
Right.
While horizontal is down 35%, vertical SaaS is actually up 3% over the last 12 months.
The underlying mechanism there has to be data gravity, right? And compliance.
That's exactly it. They have switching costs that are existential, not cosmetic. Consider Viva in the pharmaceutical industry. They own irreplaceable proprietary data moats and complex FDA compliance workflows that they've accumulated over a decade or more.
So an AI can't just fake that.
No, an AI model cannot just guess or hallucinate 10 years of highly regulated industry-specific clinical trial history. Therefore, AI acts as an augmenting feature that strengthens these vertical platforms, rather than a threat that displaces them. The AI actually needs the vertical platform's proprietary data to function legally and accurately.
Okay, let me push back on the horizontal collapse for a moment, though. We're looking at giants like Salesforce and ServiceNow. These companies have essentially unlimited resources.
They do.
They have massive distribution networks, thousands of engineers, entrenched relationships with enterprise CIOs. Can't they just, bolt an AI chatbot onto their existing platforms and crush the upstart AI native companies through sheer distribution?
It seems like they should be able to. But the incumbent dilemma is much more complex than just distribution. It's true, 54% of CIOs do actually prefer to buy AI from their existing vendors.
Yeah.
They want vendor consolidation.
Right.
But the incumbents are struggling immensely to capitalize on that for three distinct structural reasons. First is budget cannibalization.
Meaning they're eating their own revenue.
Exactly.
Yeah.
45% of AI budgets are coming directly out of existing software spend. So even if the CIO buys the incumbent's new AI tool, they are paying for it by canceling other legacy licenses from that exact same vendor. It becomes a zero-sum game for their top-line revenue.
Wow, so that makes sense financially, but what about the product itself? Why can't their massive engineering teams just build better AI?
Well, the sources explicitly highlight the refounding mandate. Legacy companies must mentally assume their current business is completely worthless to survive this transition. They have to execute a complete architectural reset.
That's a tall order.
It is. For decades, software development was deterministic. You listen to the customer, a coder writes an if-then rule, and the output is guaranteed. If the user clicks here, open this window.
Right. Very rigid.
But AI requires probabilistic development. You are managing a model that calculates the next best action based on millions of variables. You aren't writing strict rules, you're setting boundaries and guardrails. It's possibility-led development. A legacy company built on rigid deterministic code literally has the wrong DNA for this.
That is a massive cultural and operational shift for a company with 50,000 employees. I mean, it's like asking a team of structural engineers who build bridges to suddenly start breeding racehorses. It's a completely different science.
Yeah, that's exactly what it is. And that operational shift extends directly to their pricing models too. Legacy SaaS is built on seat-based annual recurring revenue. If you want more revenue, you sell more licenses to more humans. But if AI is doing the labor,
the human seat count inevitably shrinks. So we see terminal value compression, meaning the market is looking at these giants and realizing their future earning potential is shrinking towards zero because their core pricing model is tied to a metric human headcount that AI is actively destroying.
to survive that terminal value compression, these incumbents must shift to outcome or consumption-based pricing. They have to charge for the work done, not the software seat.
Yeah, how is that going for them?
Well, when they try to just bolt AI onto a legacy system and charge a premium, they face brutal market pushback. The research cites an automotive executive reviewing Salesforce's new agent force, and he basically calls it an oversold, overpriced chatbot that overpromises and underdelivers.
Ouch. And while these incumbents are wrestling with budget cannibalization, cultural refounding, and pricing model collapse, they're being attacked by startups that carry zero of this baggage. Which brings us to the AI-native operational alpha.
Yes.
We mentioned the old rule of the SaaS, you have to scale your human headcount to scale your revenue. These new AI-native startups have completely shattered that law of physics, haven't they?
Oh, completely. The productivity metrics coming out of these startups are staggering. Look at AI-native companies like Cursor. They are generating $6.1 million in annual recurring revenue per employee.
$6.1 million per employee.
Yeah. And Lovable is generating $3.4 million in ARR per employee. Meanwhile, a legacy giant like Salesforce generates roughly $0.5 million in ARR per employee.
So the startups are operating with an order of magnitude more efficiency. They don't need sprawling middle management layers or massive HR departments. They're just a core team of elite probabilistic engineers and fleets of AI agents doing the operational heavy lifting.
Exactly, which leads to a dramatic collapse in the time it takes to reach hyperscale. Historically, before the 2000s, the median time it took a company to reach a $50 billion valuation was 25 years.
25 years, okay.
But for modern AI firms, that median time is compressed to just 9 years. They are scaling revenue incredibly fast without accumulating the structural bloat of a massive human workforce.
So let's round this in practical battlefield tactics. If I am an AI startup aiming for that hyper-accelerated scale, how do I actually take on a giant like ServiceNow without getting crushed by their existing enterprise contracts?
The intelligence outlines 2 highly asymmetric go-to-market playbooks that AI startups are executing to bypass incumbent defenses. Playbook 1 is known as the wedge.
The wedge.
Yeah. Startups like Sierra or Decagon aren't walking into a CIO's office and asking them to rip out their massive, complex Salesforce or ServiceNow databases. That would trigger a multi-year procurement nightmare. Instead, they sit right on top of those entrenched systems as a new intelligence layer.
So they intercept the user. Like if I'm a customer service rep, I chat with the AI interface. The AI goes into the complex Salesforce database, finds the information, and brings it back to me. Salesforce just becomes a dumb pipe, like a silent filing cabinet in the background?
Precisely. By intercepting the interaction and providing the actual intelligence, the startup strips the value capture away from the incumbent. The incumbent keeps their database for now, but they lose their direct relationship with the user, and consequently, they lose all their pricing power.
That's brilliant. And Playbook 2.
Playbook 2 attacks the SMB and mid-market. It is classic disruption from below. Companies like Adeo realize that incumbents are bloated, heavily customized, and prohibitively expensive for smaller businesses. So they rebuild the CRM product from scratch, making it simpler, cheaper, and AI native from day one.
So they just win the millions of smaller customers that the enterprise ignores today.
Right, with the strategic goal of capturing the future as those smaller companies naturally grow into enterprises themselves.
Okay, so we've laid out the macro environment, the structural winners and losers, the underlying mechanics, and the battle tactics. For you listening right now, whether you're managing an investment portfolio, leading a tech company, or just trying to navigate your own career, what is the strategic investment window here? Like, when does the life-changing money actually get made in a shift this profound?
Well, this is where we look to historical data. If we analyze the internet era, the cloud era, and the mobile era, a very clear pattern emerges. The generation-defining companies, the Googles, the Snowflakes, the Ubers, they are overwhelmingly founded in years 4 and 5 of the platform shift.
Years 4 and 5. And year 0 for this current shift was the launch of ChatGPT, right?
Exactly. ChatGPT launched in November 2022. That puts us currently moving into year 4, which means the 2026 to 2027 period is the historical sweet spot for deploying capital and establishing the companies that will dominate the next decade.
Okay, but let's talk about the private market valuations, because on the surface, they look terrifying to any rational investor.
Oh, yeah.
I mean, Series B and C private AI startups are trading at a 61x ARR multiple. Meanwhile, public high-growth software is trading at less than 10x. It looks insane on paper. It's like paying $1 million for a tiny sapling. How do we justify that math?
It sounds totally disconnected from reality until you factor in the growth adjustment. Yes, the entry multiple is 61x, which is exceptionally high. But the median ARR growth rate for these Tier 1 private AI startups is 640%.
640% growth.
Okay.
If that sapling is going to grow into a fully mature redwood by next Tuesday, the $1 million price tag starts to make mathematical sense.
Right. Compare that 640% to public high-growth software, which is growing at roughly 29%. When you divide the valuation multiples by the respective growth rates, the picture entirely flips.
How so?
On a growth-adjusted basis, private AI startups actually trade at an 86% discount compared to public high-growth software.
Wow.
You're actually paying significantly less per unit of growth in the private market right now, assuming they can sustain that operational momentum.
Okay, so synthesizing all of this intelligence, what is the final verdict? What does the granular strategic stack look like for someone trying to position themselves over the next 5 years?
Based on the structural realities we've analyzed, the strategic outlook dictates 4 clear mandates. First, underweight horizontal SaaS. Companies built on solving coordination problems face severe terminal value risk from native AI replacement.
Got it.
Second, overweight vertical SaaS. Their proprietary data gravity and strict compliance modes make them highly resilient. Third, overweight infrastructure. The transition from a software TAM to a labor TAM creates massive direct compute and data center tailwinds.
Makes sense.
And finally, overweight private AI native companies, particularly at the Series B and C stages, to capture that hyper-growth valuation arbitrage before they go public.
Software is eating the world. AI is eating the labor.
Which leaves us with one final lingering question to ponder. If AI native companies are completely decoupling revenue from human headcount, hitting millions in recurring revenue per single employee, what does the future Fortune 500 megacorp actually look like?
That's a good question.
Could we soon see a billion-dollar publicly traded company run by a single human founder and a fleet of autonomous agents? And if that happens, how will the stock market or even society define labor 10 years from now?
Something to keep you up at night, or perhaps get you up early to start building. Stay curious out there.